Well, joining us now in the conversation is Radhika Gupta, MD and CEO of Edelweiss Mutual Fund. Radhika, great to speak with you on NDTV Profit on pre-budget morning. Excellent to have you here. And I'm going to start with something you tweeted out yesterday, actually, which I found very interesting, where you've talked about what the economic survey says on derivative volumes. And I thought that was I was keen to know your view. You've said, I have seen people in their 20s saying they don't need to work because they're busy doing F&O. Young women who say their lifestyle and handbags are funded by trading gain. Economic survey highlights this in some very strong language. Other regulators have also rightly and repeatedly warned us. It is time something is finally done about this form of liquidity that is both unproductive for the economy and dangerous for the individual. Now, that is a very interesting stance, Radhika, and I wanted you to elaborate on that. When you say it's time something is done, what do you mean? What do you want to see done?
So, firstly, I think before I say what should be done, and I'm sure people have, and I don't think the only answer is, going to be found in the budget. The stance that I have on F&O trading by individuals is a stance that seems to be very popular, and rightly so. It's been, SEBI chief has alluded to this in the form of non-capital asset formation, non-productive kind of liquidity. RBI governor has talked about this. Economic survey has used some extremely strong language. I think there are two things that can be done. One is a budgetary matter, which is potentially some increase in taxation on STT or any kind of taxation that is related to short-term capital gains, not long-term capital gains. I mean, STT on F&O looks like the expected, outcome or anticipated outcome. SEBI, I think, separately will look at increasing the lot size because there's nothing wrong with F&O. F&O is for institutional use and for those who know how to use it. But the average 25-year-old using F&O and using options to, lose more than they have is a problem. So increasing the lot size. So some of it I expect from budget, some of it I expect from outside budget, but it looks like a coordinated mechanism at the highest levels to address this problem.
So let me then ask you one more question, which is a problem, quote unquote, from a regulator's view. And here's the RBI governor talking about the diversion of savings into mutual funds, rather into banks, is going to be an issue. Now, you are on the other side of that quote-unquote problem. How do you look at that debate? Because then that debate also says that people have a right to choose what to do with their savings, right? People don't want to put it in FDs anymore. And the RBI governor says that could structurally be an issue for banks.
Yes, I think the RBI governor is making a point that loan growth should not run ahead of deposit growth. I think that is the problem that is being pointed out. I think it's less of, and why is deposit growth not happening? That's a separate issue. But the point that the RBI governor is making is that systemically, if loan growth, if credit growth is running ahead of deposit growth, which it may be seeming to, and we have seen multiple banks earnings calls talking about challenges in deposit growth, then it's a structural problem. I am not sure I completely buy this argument that all FD money is going to mutual funds and banks, to mutual funds and equities, because finally money is moving back to the same pool. By the way, most of the large mutual funds in the country, I think of the top 5, 4 are bank-owned mutual funds. So it all moves back to the same pool. And I think the FD investor is a little bit different from the the equity investor. So I don't know if I buy the argument in totality. A small part of savings, are they moving to investments? Yes. Is that a natural process of financialization that has happened in China and the US and is happening in India? I very much think so. So I do think people have a right to decide how they want to save. And finally, I think from an India point of view, money going into long-term equities, money going into SIPs has the best multiplier effect on the economy. This is productive assets. This is domestic capital formation that helps India when FIIs redeem money. So I don't think that, I think RBI is pointing out a very different issue, and I don't think MF is the cause of all people not doing FDs.
So then what is the cause, Radhika? I mean, I think SBI has gone on record and said that rationalization of taxation on fixed deposits in line with other asset classes could help. If all the money is not coming into mutual funds or equities, Where is the money going? Because FDs are dropping, consumer spending is dropping, mutual funds has gained a little bit, but not all of it, right?
Yeah. And by the way, on this rationalization of tax, if I can just make a point, till last year, debt mutual funds had capital gains taxation. Last year, that was changed because it was believed that debt mutual funds finally generate interest bearing income from interest that should be on parity with FD. So it's a little bit of a sticky argument to go back and now say, hey, deposits are dropping. Let's make FD on par with equity. Then what happens to debt mutual funds? This is a tad bit of a circular argument, isn't it?
Radhika, talking about taxation, I don't know, some quarters of your industry are of the opinion that after what we saw on debt capital gains last year, it could be arbitrage funds that could see a change of taxation. Of course, arbitrage funds have had phenomenal returns. I mean, I think a lot of money is going into arbitrage funds, even if it is long-term equity money, right? So it's become a really good parking place in that sense. And maybe some part of the short-term FD money is also coming into arbitrage funds. Is that an opinion you stand as well with, that maybe some tweaking of taxation in arbitrage funds is likely this budget? And if that happens, what could be the impact?
No, firstly, we run one of the older arbitrage funds in the industry, and the whole arbitrage category is 1.5 to 2 lakh crores. And if you look at the money that would have come in the last year, it would have been maximum 60, 70, 80,000 crores. So I don't think the entire pool of FD money is going to arbitrage funds. In fact, I deal with many, many treasuries. Some of them do arbitrage funds, but the whole world doesn't change their FDs to arbitrage funds. Now, this arbitrage fund taxation tweaking, I've heard of this. I'm not saying it can't happen, but it's a little bit tricky because arbitrage funds are not recognized anywhere in the Income Tax Act, right? The Income Tax Act refers to equity funds and funds that have 65% more of equity exposure. Now, if you have to tweak this, you have to say that equity exposure has to be net equity exposure. It can't be hedged equity exposure. Then it just doesn't affect arbitrage funds. It affects the whole balanced advantage fund category, the equity savings category, the multi-asset category. So the issue, if it has to be addressed, is going to be a lot more complicated than arbitrage funds. I don't think arbitrage funds are such a big problem or such an outlier for the whole world. They also have daily mark to market. So I don't think they're comparable to FD also in entirety.
Radhika, sorry, may I come in? Neeraj here, of course, good morning. But can some tweaks be made? I know you said it's not easy, but not entirely out of the box. I think the argument coming in is not from a perspective of maybe just that they are comparable to FDs, but because deposit growth shore up is not happening and arbitrage funds are a great option out there, but being taxed at a much lower rate. So maybe bring them at parity with FDs and let the investor then decide whether they want to choose the arbitrage fund route or a bank deposit route. So while not easy, could it be possible though?
So the way you would have to do it, technically in the Income Tax Act, Neeraj, what arbitrage funds enjoy is equity taxation because they are 65% equity. The Income Tax Act doesn't refer to any class of mutual funds. It doesn't have a call out for arbitrage funds. What you would have to do, if you had to do this, is amend the Income Tax Act to say that, boss, it is 65% equity, net directional equity exposure. If you so did that, it would affect arbitrage funds. It would also affect the industry's very large category of balanced advantage funds and a bunch of other things. So that decision, if it were to be done this way, would have multiple different ripple effects. Unless the Income Tax Act called out arbitrage funds, can be done is a little unlikely in my view. And I don't, like, as I said, the pool is not so big for anyone to care.